Okay guys, so warm welcome to today's video where I'm going to be touching on the GER30, the stock market index for Germany, because the markets are now buying the GER30 index, getting invested into German stocks because the vaccination program is finally starting to get rolled out across Germany and Europe, and growth expectations are turning back higher. So what I'm going to do is, guys, I'm going to break down why the GER30 index from 2016 to 2018 was strong, with the German stock market going up 55% over that 2-year period, and then it was flatlined over a 2-year period between 2018 to 2020 because the German economy was not growing. And then now we finally got above last year's high because of the expectations for growth to really pick up in the German economy. So what we're going to look at, we're going to look at some Excel spreadsheets, we're going to look at some manufacturing and services PMI data, which predicts GDP growth in Germany with a high certainty. And this is the data the markets are looking at in terms of their expectations for growth in the economy, and they're buying the index now in anticipation of higher earnings for these companies, which is why we want to be positioned in the GER30 index and buying it at this moment in time, so we can get into a new cycle of growth in Germany represented by a bullish stock market. So manufacturing PMI is a major economic indicator that the markets look out for when trying to predict if an economy is going to grow or contract, because remember, GDP growth is the total value of everything produced inside of an economy over a 12-month period or any given amount of time, and it's the companies within that country, it's their earnings on how much they're producing, which is going to derive whether GDP is going higher or lower. If they're producing less goods, then GDP is contracting. If they're producing more goods, GDP is expanding. And they're only going to be producing more goods if they expect to sell these goods in the economy, so they expect the demand to be there for consumers. So Germany is a very big manufacturing exporter in the European Union, and the GER30 index is made up of some of the biggest companies that are manufacturing goods in Germany. So what we can see is when we look at manufacturing versus GDP growth, first, for just to understand manufacturing, when you have a reading above the level of 50, this is indicating there's going to be growth in the manufacturing service in the manufacturing industry, and that means higher earnings for manufacturing companies. If you get a reading below 50, that means contraction in the manufacturing industry and lower growth for these countries. And there's a survey asking a bunch of questions to purchasing managers about the outlook of their business. And basically at this moment in time, we've got the manufacturing data, which is above the level of 50 and growing. And as we've seen in the past, when you can see highlighted in blue you have manufacturing, and then highlighted in red you have GDP. And every time you get manufacturing above the level of 50 and growing and moving to the upside, we can see we get positive growth in German GDP. And when manufacturing starts to decline from 50 and starts to go lower, you can see that GDP starts to decline in the manufacturing sector, and GDP then starts to decline alongside the data. So you can clearly see that the manufacturing data and GDP, they literally move with each other in a wave formation, because GDP is only going to be expanding if the manufacturing sector and the services sector are both pointing towards growth. I'm gonna touch on services after the manufacturing. I just want to understand this key correlation between the two. And what we can see is when we match up the GER30 stock market index yearly returns based on the percentage returns, and then we match up the manufacturing data, you can clearly see they move alongside each other, because the manufacturing data is predicting what's going to happen with GDP growth over the next 12 months. And if investors believe that GDP growth is going to be positive, then they're going to buy the stock market now in anticipation of higher earnings in these companies and make a profit from the share prices moving to the upside. So what I want to show you is we can see between 2016 up until 2018 the stock market rallied by 55%, and this was because if you go back to our spreadsheet, we can see that the German manufacturing data between 2016 to 2018 was expanding. So there was expansion in the manufacturing sector, and that meant that the markets were predicting GDP growth to be going higher. And if GDP growth is going higher, then these manufacturing companies are obviously going to be producing more goods to sell into their economy or around the rest of the world, and therefore they'll be earning higher profits. And you can see GDP growth was actually getting bigger and bigger as the manufacturing data was moving higher and higher above the level of 50. So that's why we had growth in the manufacturing sector. However, from 2018, the manufacturing data then started to decline, predicting negative growth in GDP or contraction in growth in GDP. And no surprise, GDP then started to come up negative, and this happened between 2018 all the way into 2020, and that is why over the next 2-year period the stock market didn't grow at all. It was flat for a 2-year period. It only went up 1.37% over a whole entire 2-year period. So clearly the markets are using the manufacturing data to predict growth by the stock market, and when the manufacturing data starts to decline, then they're not going to be investing in the stock market because they're not predicting the earnings of the manufacturing sector and the general economy to be growing. So you only want to invest in markets that are expecting growth, because then you want to be buying stocks that will reflect this growth expectation by moving higher, and investors obviously therefore make a profit. So at this moment in time, for the first time, the manufacturing data now is above the level of 50 in Germany, currently 60.7, that's positive. And the services PMI, which also, as you can clearly see from the picture, works in exactly the same way as the manufacturing, but most importantly, the services sector makes up a larger proportion of the economy. So when you have both the services sector and the manufacturing both above 50, both pointing towards growth, and that's when the markets really start to commit capital into the German stocks for the 30 biggest companies in the index, and that's what's pushing the German 30 at this moment in time above finally last year's high. We're now currently moving by around 5.5% to the upside. Now, the services data is not actually above the level of 50 yet. It's only at 45.7, but it's because of the vaccination rollout across Germany that obviously the more people get vaccinated, then obviously shops can open, cinemas can reopen, and these are all service-led businesses. And once that economy starts to reopen and business goes back to normal, then we can expect Germany to go for a high amount of economic growth, and therefore the investors will be buying the stock market in anticipation of this happening, and they're going to get in position themselves now, which we've already started to do, which is why the German stock market is now finally pushing to the upside. So what this basically means for us is, soon as the services data gets above 50, then that is basically telling you that the manufacturing and the services sector is both predicting growth, and they both make up 100% of the economy. And if the economy is expected to be growing 100% in both the services and manufacturing, then that is the green light we want to be buying a stock market index just like the German 30 at this moment in time. So you want to get invested, you want to be buying this. This is the understanding of the macroeconomic data that the markets are focusing on, because surveys are really important for us to understand what's going to be happening in the German economy. Another key economic indicator is consumer confidence, because if consumers are confident, they're going to spend more, save less, and that obviously drives corporate earnings, higher GDP growth, and therefore a more bullish stock market. So this is a trade that I'm going to be entering into the markets. I should be buying the German 30 index. You can either buy now, or you can wait for the services sector to be above the level of 50. But as long as this vaccination campaign can get underway and they can really start to vaccinate their people, and businesses start to reopen, then we definitely want to be buying stock markets like Europe, which now for the first time in over 3 years will finally start to be experiencing some growth, because the key economic data that markets are using to buy a stock market is giving us the green light towards buying the stock market index. So just remember, guys, whenever you're buying any stock market, you must look at the manufacturing and the services data, because they're the two most important surveys alongside consumer confidence that's going to predict whether an economy is going to go through growth or contraction. Now, you can trade this with me, you can trade this with my members. We've already been buying the US stock market aggressively, because the US stock market expectations are much more bullish than Europe, because of obviously the US vaccination campaign is well underway. They've got huge fiscal stimulus coming through the US at the moment, $1.9 trillion from the Biden administration, monetary support from the central bank, and that's why the markets are buying the US stock market more aggressively than the European stock market. But if you understand it's the data that the markets are using to buy a stock market or not, now you know that the German stock market is probably going to start to pick up as well. So you can either buy that now, you're probably going to get in at a better price than the US stock market. But either way, the stock markets are bullish because the data is pointing towards growth, and that's what we want to be buying in the markets. Whenever there's growth in GDP expectations, you will see a stock market move higher year after year after year. That's what we saw for the US stock market going from 2008 all the way to 2020. 2009, my apologies. 11 years the US stock market was going higher because GDP kept going higher and higher in terms of growth. And as long as the GDP growth is expected to expand, then markets keep investing in the stocks, because Therefore, for GDP to be growing, the earnings of these companies have to be growing, because GDP is basically the value of everything being produced by the businesses within an economy. So come join my free trading team on Telegram. I've got free analysis, free videos. Sometimes I share some free trades. If not, then you can join my premium member service, where I do share loads of investment opportunities that I personally take, as well as educational material, weekly webinars, so on and so forth. But I hope you take this information. I hope you use it. If you want to get your hands on my spreadsheets to understand how to anticipate these growth expectations, you can just get in contact with me. But right now, guys, the German 30 looks like it's on the move as this vaccination campaign gets rolled out in Germany and Europe. So we want to be buying, want to be trading it, want to be investing in it. Get involved. Come join my trading team, and I'll hear from you soon. Thank you.